Global markets are steady ahead of the Fed's expected rate cut tomorrow. Australia's disinflation progress is set to have stalled. And South Korea gets a growth bump from a mid-year fiscal stimulus package. That's coming up in our 5 Things in 5 Minutes on Wednesday, October the 29th. And then in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes looks at how new US sanctions on Russian oil companies might affect the global market.
OPEC certainly stands as the most obvious producer group that could potentially offset this loss.
But first, in 5 and 5 with ANZ, markets were steady overnight ahead of the Federal Reserve's Open Market Committee decision on US interest rates tomorrow morning, Sydney and Melbourne time. ANZ Research expects a 25 basis point cut and an announcement that quantitative easing is coming to an end. ANZ Group Chief Economist Rich Getzinger says Fed Chair Jerome Powell has had to navigate 3 different influences.
The normal economics that every central bank deals with. The second thing is this policy-induced adjustment because of the imposition of tariffs. And thirdly, obviously what's going on behind the scenes with the Fed and the White House perhaps finding their relationship a little more complicated these days. And so what he's tended to do is try and stick to the core economics as much as he can and not give too much forward guidance. And I expect him to continue with that frame. But even with that, I think markets will see enough in the Fed Chair's commentary after the Fed cut, which is our expectation, to price in further easings.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.2% and the Nasdaq up 0.6%. The yield on the US 10-year Treasury was down 1 basis point at 3.987%. West Texas oil futures were down 1.9% at $60.13 a barrel US. Gold fell a further 1.25% to $3,969 US an ounce, and it did go as low as $3,901 an ounce. The US dollar index was down 0.1%. The Aussie dollar rose 0.4% to 65.83 US cents, and the Kiwi rose 0.2% to 57.83 US cents. Number 2, Australian disinflation progress likely stalled in the third quarter, says ANZ senior economist Adelaide Timbrell. Adelaide is forecasting headline inflation of 1.2% in the quarter, well up on Q2's 0.7%. That would see a headline rate of 3.1%.
But what's going to matter more for the Reserve Bank is a trimmed mean measure, which takes out the most volatile series to create an underlying trend of inflation. We think that in Q3, the trimmed mean was up 0.9% or 2.8% through the year. This is likely to be uncomfortably high for the Reserve Bank board if they do want to cut rates, and is likely to lead to a decision to hold rates in November, despite the increase in the unemployment rate in September to 4.5%.
Number 3, Australian consumer inflation expectations rose a bit last week ahead of the data, according to ANZ Roy Morgan's Australian Consumer Confidence series. Here's ANZ economist Sophia Ngala.
So that tick up in that weekly inflation expectations measure does come ahead of the Q3 CPI print that will be released later today, and which we do expect to point to a stalling in annual disinflation. We didn't expect that outcome to be a start for a new trend in inflation, and we continue to expect annual underlying inflation to reach that midpoint of that RBA's 2 to 3% target band in the second half of 2026.
Number 4, headline ANZ Roy Morgan Australian Consumer Confidence rose 1.8 points during the week to 85.5. Here's Sophia again.
That series is up nearly 3 points over the past fortnight. Last week's rise was driven by improving household confidence in their personal finances, but notably weakness is still persisting in how households are feeling towards the 5-year economic outlook. Household confidence there is still hovering at around decade lows.
Number 5, South Korea's GDP grew 1.2% in the third quarter, according to early data yesterday. That was above expectations. ANZ economist Crystal Tan says mid-year fiscal stimulus led to a bump in consumer spending.
Well, I think it's that the Bank of Korea has scope to be more patient, given its concerns about housing market stability. This reduces the odds that the Bank of Korea will feel the urgency to move again in November. It now has more time to wait for the clear signs of housing market stabilization that it's looking for.
Crystal Tan there. Now, in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes reviews the implications of the new US sanctions on Russian oil companies.
We've seen since the Russia-Ukraine war started, a variety of methods used to curtail Russia's revenue-generating ability, namely being through price caps implemented by the G7 nations, as well as European sanctions as well. But the US is obviously the centre of the world financial system, and so these sanctions that they've placed on the two biggest Russian oil companies will have a significantly bigger bite than those previous efforts. We've already seen refiners, particularly from India and China, who have been sort of reluctant to stop their purchases of Russian oil to date, already starting to intimate that they won't purchase any more due to these new sanctions. So I do think the bite or the impact of this latest round, is going to be significantly bigger than what we've already seen. And the volumes, are potentially quite significant. The two producers, Rosneft and Lukoil, produce about half of Russia's oil exports. So we could have around 1.5 million barrels a day really at risk of being disrupted as a result of these US sanctions.
Is there the potential for, over time, this oil to leak out, if you like, through other measures? Because that's been one of the features of the last couple of years, is that Russia has found ways to get the stuff out there.
Yeah, and I don't put it past them that we'll see production and exports hold up relatively well. But the US getting involved with these direct sanctions is definitely a step up and will be significantly harder to get around, certainly if those buyers want to remain a part of the US dollar financial system. So I do think there'll be some sort of impact, certainly in the shorter term. Maybe over the sort of the medium term, if these sanctions remain in place, we may start to eventually some of that disrupted oil return back to the market. But I do think, it's got a lot more bite, these US sanctions, than all the other efforts that we've seen to date to try and curtail Russia's energy revenue.
Do you think there's the prospect that other producers could increase their output to offset the hit from Russia, given, in recent months we've seen, slight increases in oil production from OPEC plus countries?
Yeah, I think OPEC certainly stands as the most obvious producer group that could potentially offset this loss. And we've already seen a couple already intimate that they're willing to boost output if we do see disruptions emerge. But it's interesting, the OPEC group itself has actually been underperforming against the current sort of increased quotas that the group has approved for its members. So there does appear to be a constraint on the amount that some of the members can actually increase by. And I suspect there's been issues around, a lack of investment over the past decade, which has effectively brought down their capacity, even though they're producing well below what they have in the past. So the ability of OPEC to react to this in the shorter term, I think, is it was not as great as maybe people suspect.
And do you think the price reaction we've seen so far includes all of the potential risks here for supply, given what we know about demand?
Well, I think there's obviously going to be a lot of talk around these sanctions at the trade talks between the US, India and China. So I think the market is just sort of hedging its bet a little bit, so not fully pricing in the potential for that type of disruption, in consideration that maybe there'll be something emerge out of those trade talks which could potentially change the dynamic around this. But certainly in regards to the US and Russia, we've seen obviously the summit that was supposed to be held between Putin and Trump already been cancelled. So there's clearly no issue, I think, in the shorter term on that side of things, which is going to change the dynamic drastically. But I think the trade talks will be something which the market will just have to be conscious of before, I suppose, they start to fully price in the impact of these disruptions.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, October the 29th. Catch you tomorrow with what Australia's third quarter inflation data could mean for the Reserve Bank of Australia. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.